Well, good afternoon, everybody, and welcome to the third instalment of Conversations on the Couch here at Empire. The scale of funds that we manage here at Empire and the collective reach and contacts of the members of our investment committee mean that we have access to investment solutions that either aren't always available to the general advisor community or that may be available to us on preferential rates. And also includes often the ability for us to have access to the chief investment officers, the portfolio managers, the people who are making the decisions and pulling the levers inside of these funds. And today in particular, we're very fortunate to have Paul Xiradis from Ausbil come along and join us for this episode of Conversations on the Couch. So Paul founded Ausbil in 1997, I believe. Today Ausbil manages circa $16 billion in funds. Started off as an Australian equities managed fund manager, but today is running Aussie and global equities. Paul is the executive chairman and chief investment officer at Ausbil. So welcome along, Paul. Thanks for coming along.
Happy to be here.
Wonderful. A couple of questions for you relating to the philosophy behind Ausbil and how Ausbil manages its funds. As an active fund manager, and there's lots of debate around the difference between all the benefits of active versus passive, what do you and what do Ausbil fundamentally believe that share markets allow us to do that active management will add returns over and above the index?
Look, it is an interesting debate, I must say, and it has been a debate which has been around for many years. But Australia, as a start point, has a history of actually delivering over and above index returns by a range of active managers for a number of years. That has not always been the case in other countries, particularly the US, where that has been a concern or a rage that the active manager tends to underperform in those markets, but here the average manager in Australia tends to outperform. For us, our start point is why we think we can continue to do so. And we've been managing money, as you correctly said, for over 26 years, or about 26 years. And we have a very good history of delivering performance over and above the benchmark. It's actually before fees 3% per annum for the past 25 years, which is a great outcome, I think. Mm. But it really is testament to our process and the way that we apply our process. So to answer your question in full, we believe, yes, the markets are relatively efficient, but not perfect. And if you adopt what we refer to as a style neutral or a core investment process, it allows you to exploit the inefficiencies across the entire market. We don't restrict ourselves in any way, shape or form by just looking at those stocks which are typically regarded as value stocks or growth stocks. We look at the entire market when we look to exploit the inefficiencies or opportunities, so to speak. But you need to have a core belief, though, in doing that. You need to have a process which allows you to do that on a consistent and a constant basis. And our core belief is that earnings and earnings revisions are the key driver of share prices. So put simply, where earnings go, share prices tend to follow, and vice versa. So we have a process which tries to identify those trends at a very early stage, position ourselves accordingly, and then on confirmation of those earnings trends, amplify our positions. Or contrary to that, if we position ourselves and we don't get those confirmation, we can exit our position rather quickly and reinvest those proceeds in other stocks and sectors where we see that upside.
Yeah, so that process, you're mentioning your process. So what is it specifically about the process? You mentioned about following the earnings. Anything else about your process that will lead to that consistency and the repeatable excess returns? You talked about 3% on average over that 25-year, almost 26-year period. What is it about your process that will lead to that being repeated and being consistent moving forward?
We're a little bit unique in the Australian market where we regard ourselves, as I said, core, but we're a top-down, bottom-up manager. What that means is that we look at the bigger picture first because we think that gives you an early indication or early clue of where the earnings risk and opportunities do lie. We have an in-house economist, which has been, I've had 2 economists over the past 25 years over the period, in the sense of one retired and I've had another one who's joined and has been with me for over 10 years now. But very much part of our process, who looks at the bigger picture first, leads the discussion about the bigger picture in the sense of where growth may be going internationally, domestically, where interest rates may be going, where inflation may be going, where currency may be going. Why do we do that? Because all those factors really influence the ability of companies to actually generate earnings and returns. We also do have a 3-person in-house team which look at commodities and commodity prices alone, where again they build their own forecast of where they think commodity prices are going based on supply and demand, which also incorporates our top-down view. And we also have an experienced portfolio management team which looks at earnings right across the sector and determines where we think earnings risk may be as well. So it's a combination of factors from a top-down perspective.
Paul, you were mentioning before the value and growth. They were 2 different styles that you were mentioning before. The way that you go about building your portfolios, what sort of your process? What sort of portfolio does that end up creating? Would you describe Ausbil as growth or value manager or something else?
The way that we are positioned, or our composition of our portfolio, be it a value or a growth, is a product or is the outcome of our process. We don't wake up one morning and say we need to be more value or we need to be more growth or we need to be value or growth, because we look at the entire market. It really is an output of our process. So what we do is, from a top-down perspective, which I described, look at the bigger picture first, come up with a set of conclusions. Those conclusions are passed on to each sector. Then I have a team of sector analysts which actually build their earnings models based on those conclusions and also the factors which influence a particular sector. Obviously build the models regarding the companies, but it really is driven on where we see the best earnings outcomes will be. And at times it may be more cyclical in the sense of where the earnings growth may be coming from over a period, and they traditionally tend to be more value-orientated companies. Or it could be where growth is really hard to come by, and that's where I think we're in a period right now where earnings growth is going to be really hard to come by. So some of the growth companies may do better in that environment, and I can explain the reasons behind that. So it really is, part of it really is an output of our process. So because as we said, we're style neutral core. So over the period, we can have a value outcome, or we can have more of a growth outcome. But over the period, we tend to be right in the middle, in the sense of being style neutral core.
Okay.
Does that make?
Yeah, no, it makes a lot of sense. I'm hearing an overwhelming theme though about earnings.
Absolutely.
And following earnings, which makes a lot of sense, doesn't it? You're wanting to buy into companies that are making money.
Yeah, correct. And I think that's what we really boil it all down to. So our process is trying to identify those stocks and sectors which are not only going to deliver on those earnings, but could also be better than what the market's expecting, or an environment where earnings are very hard to come by, are those stocks which would deliver earnings where the rest of the market is not. Yeah. Because again, if you the logic is such where earnings is quite abundant, valuations tend to be a little less. Where earnings become far more scarce, you're prepared to pay a premium for those earnings because they're very hard to come by. So it's just human nature, really. So we're quite pragmatic in our process. We don't want to get hung up on saying, well, this is a value stock or a growth stock, because what it does do is restrict your universe, and it restricts the ability for you to add value.
Makes a lot of sense. We mentioned before ESG and some discussions that we were having prior to coming here on camera around different opportunities, but some of those ESG considerations, and I guess for some of our viewers who may not be familiar with what ESG means, the environmental, social and governance overlay into any particular company that we're looking at buying into. What's Ausbil's view on ESG? And how is ESG incorporated into the stock selection process? It's becoming an increasingly important theme and consideration for our clients. So how's Ausbil incorporating that into their process?
A very good question, and it's certainly gaining more and more traction in the marketplace. And some of the risk associated with that there's a few people out there which are just now starting to incorporate that in their process. Ausbil's has always been very strong on governance from the very beginning, but we have incorporated and expanded our focus to the extent that we have a 3-person team just on ESG. So they are independent in the sense of doing their ESG analysis, but also they co-populate and also co-mingle with our financial team. So we are integrated from a financial perspective of their concerns and also highlights of their risks as they see it. It fits in very nicely with our process because we are earnings and earnings revisions and earnings risk. So ESG tends to be something which can be a bit of a slow burn in the sense of the earnings risk of a particular company, such as underpaid workers, for instance. You know, you're not aware of it until it hits the press. Yeah. In most occasions, and it's actually quite a drama, and also has an earning impact and also a valuation impact, as an example. But we can actually pick up these things before they actually hit the press by a number of different mechanisms that my ESG team actually adopts. So we have identified some of those earnings risks before they do occur. So it's important, you know, we think it's really incorporated. It really is important to understand some of the risk associated with running today's businesses. And also modern slavery is another area which is clearly something which is gaining more and more market share, or more market focus rather. Again, you know, I have an individual who specialises in that internally and has also, you know, shaped thoughts and also legislation in the sense of assisting in government drafting in the sense of what people, organisations should be looking for. So it's very important, yes.
Wonderful. Some general questions on the market and market outlook, not necessarily specific just to Ausbil, but just some general questions about, I guess, where Ausbil sees or where they're positioning themselves in their equities portfolios given the current economic outlook. We've had quite a bit of volatility over this last week. So in this current climate, what's Ausbil doing to position themselves for the current market climate?
It is far more challenging. I mean, that's the opening statement, so I'm stating the obvious here. But if I go back 2 steps, that last year, 22 calendar year, was a year of tackling inflation by rising interest rates. By the end of the year, our view was that we were largely through that process, where we were approaching peaking in cycle of interest rates. Didn't mean that interest rates can't go up too much further, but we're approaching the peak. We felt that inflation is also peaking out. We also felt that the US dollar was also peaking out as well. And part of the reason for that is that we are entering a different phase of the global cycle. We are expecting a slowdown globally, sourced from most major economies, including Australia. But we do vary a little bit to what the market may be anticipating as far as growth is concerned. We think the US, for instance, we think it will be a slowdown. We don't think it's going to be a crash landing in the sense of economic activity. We think Europe, after looking fairly wobbly last year, through good luck and also through good management, looks a lot better than it could have been. We are expecting a slowdown, but it will actually be a lot weaker than it has been in the past. Here in Australia, we do believe we'll be trending below, or activity levels will be below trend for a couple of years, again because of the impact of rising interest rates and also tackling inflation. But the country which is the odd one out is China. China is in a different phase of its economic cycle. It has been quite weak over the last 12 months. We think leading into this 12 months will be very strong for a number of different reasons. It has been cutting rates. Inflation has not been a problem. They have been re-stimulating and actually spending money on infrastructure through fiscal spend. But also we've seen the liberalisation, if you like, of the Chinese populace, who've been really locked down for over 3 years, who should and will start spending. So when you're looking at what's going to be the drivers from a global perspective, you've got most parts of the region experiencing slowdown. We're seeing inflation peaking, interest rates should be peaking. Australia will be slowing, but it will still be growing, and China's going to be very strong. So that presents quite a few challenges, I guess, from a portfolio setting point of view, and where you see the earnings risk and opportunities.
Okay, so you think Australia will be operating and be under trend. So the next 5 to 10 years, where do you see the Australian economy travelling relative to other economies?
5 to 10 years is a difficult question to answer because there's a lot of variables that could occur and a lot of things that could influence it. But certainly over the next 2 years, we think that Australia should outperform that of the Western world in the sense of economic growth is concerned. It will be below what we have been experiencing because it's been very, very strong. We're expecting growth around the 1.5 to 1.7% for this year and also next year, which is below trend, which is not a bad outcome compared to that of the rest of the world. China will be very strong and close to 6%. But if you're looking at the bigger picture, I think Australia is pretty well endowed for minerals, which is also held in very good stead. We are very rich in gas and oil, which is obviously important. We're also rich in iron ore and coal, which is obviously a big driver. We have, very rich in agriculture products, and we're also very rich in some of the new facing metals as well. So if you think of that, Australia's in a better position. So I would think, on balance, Australia should be a strong performing economy on a consistent basis for many years. And when you think about it, Australia has only had one period of an economic recession, and that was during the COVID period, and it was only very short-lived. Now, prior to that, we had 27 or 28 consecutive years of growth. Yeah. So, quite a remarkable outcome, really.
Yeah. Paul, thank you very much for coming along and joining us today. We've got 3 of the Ausbil funds across the 3 flagship portfolios that we run here at Empire. So it was wonderful to have Paul along and get those direct insights from the person who's in there and running these operations as the executive chairman. That's it's a wonderful insight. So thank you very much for your time. And as always, if anybody has any questions, feel free to contact the Empire office.